Good afternoon. We spent a good deal of time early in our course on financial accounting and reporting. We're going to discuss financial capital, one of the six capitals, but it's part of what is traditionally the capitals of the 20th century corporation. For a definition of financial capital, according to Jane Gleason White, financial capital are the funds available to an organization to produce goods or provide services. These funds are sourced through debt, through equity, or through grants, or generated through operations or investments. In previous sessions, we discussed the relevance of financial reporting and whether a 300-page filing with the SEC today provides any more meaning than a 2 or 3-page report did over 100 years ago. We also learned in previous sessions that the market cap, or the total value of a company, is really based on a broad array of intangibles, which we discussed were around 84% of the value of the company, as opposed to its book value or stream of earnings. From an investment perspective, we also learned that investment decision making today is very, very different than what it was 50 years ago. And that today financial information is but a small part, and in fact, as we discussed from Baruch Lev, only perhaps 4 or 5% of the investment decision-making process for the investor. There are also other facts that separate today's corporate entity from those merely 30 years ago regarding financial capital. For example, only about 15% of capital formation today is actually generated through stock offerings. And in fact, over the past few years, public companies have done just the opposite. They've engaged in stock buybacks just to reduce the number of shares outstanding to the public, which of course supports the stock price, principally to maximize the stock price, which is the principal incentive for senior executives in the form of stock options that they have been granted and that the board has been granted. So, as we would expect, most corporate financing today is internally generated or generated through adding debt and or equity, but especially debt today because this is an especially optimal low interest rate environment for borrowing funds. Finally, we also learned from Baruch Lev, based on a number of statistical studies of public companies, that while in the 1950s and 60s, 90% of a company's market value, basically its stock price, was attributed to corporate earnings. Today, only about 50% of corporate earnings contribute to stock price. We also discussed the similar relations of stock price to book value. That is, the deterioration in reported book value to the value of corporate stock was about 90% after the 1990s. So again, the relevance of financial capital is significantly reduced over the last 50 years. Let's take a look at a sidebar of Perry's ice cream, which is, of course, a case study that we've looked at or will look at in a number of different ways from a number of different capitals perspective. If we look at the 42-page sustainability report at Perry's Ice Cream, which many believe is the model for sustainability reporting in the United States, it is interesting to note that the generally accepted terms that we use, people, planet, and profit, has been changed by Perry's. And again, this is the model for sustainability reporting in the United States. It's interesting to note that generally accepted terms, people, planet, and profit, has been changed to people, planet, and grow and protect. Further, Perry's does not even mention in their grow and protect section how they will grow and protect their financial capital. That is, how are their profits distributed? How is compensation of their executives determined? And how is financial capital strategically used? I think one of the dangers in not paying more attention today to financial capital is that as a result of the concentration in financial capital among a limited number of players, that is the banks and financial services entities around the world, there's a potential for disaster when ethics and stewardship over financial assets takes a secondary role to the profits and exclusionary financial results. Many of you still remember the Great Recession, which was triggered principally by artificial or synthetic financial instruments, financial products that went bad, principally the banking, insurance, and financial services industry. Many of you do not remember that the negative impact of financial capital and wealth destruction negatively and profoundly affected many other capitals, but in a more exaggerated way. As the Financial Times reported, the global meltdown seemed to be a crisis with countless victims, but no perpetrators. Wealth destruction in excess of over $30 trillion, more than the GDP of most countries, resulted in permanent losses for some and a decade of recovery for others. In less developed countries, it forced millions below the poverty line through unemployment, resulting in human suffering and starvation. So while intangible assets create 84% of the value of the corporation, the ability of financial capital to create value or destroy value just because of its nature is significant on the entity. And as stewards and fiduciaries, we need to watch financial capital equally as well. In an ACA study, and you remember this is the global body for professional accountants, regarding the expected impact on business by 2024, the ACA business professionals in 150 countries said that instability in financial markets, that impact was more prominently felt in the Caribbean and Africa countries, and but at 80% and 72% exceeded these numbers relative to the decline in natural resources, population rise, water scarcity, climate change, and decreasing food resources. So financial capital is one of the most critical capitals still today, even though the value of a corporation lies in its intangibles. So let's go on to the next capital.